Welcome back to Retirement News Online. So we're still in what some stock market analysts call an everything bubble. And by that I mean just about every asset class could still be considered expensive right now. Now this makes a traditional 60-40 asset allocation questionable. My guest is Kris Koenig with Prime Capital Investment Advisors. And Kris, since many asset classes still seem to be correlated right now, how can you truly diversify?
Yeah, you can still diversify. A lot of asset classes are moving in stride together. But that being said, it's still very important to be diversified. Correlation is just part of being diversified. What's in favor today can fall out of favor tomorrow, and not everything moves in the same direction. So I do think it's still very important to be diversified. On the equity side, that's buying high quality companies, making sure you don't have all your eggs in one basket. You can do that by simply going out and picking a basket of stocks that you really like. Or you can kind of get instant diversification right away by buying into ETFs, mutual funds. Those will give you, you're buying into hundreds, maybe even thousands of companies by buying, one ETF or one mutual fund. On the fixed index side or the fixed income side, you've got options there too. If you like to go out and actually buy bonds, look at different durations, shorter term versus long term, government versus corporate, high quality junk. There's lots of options there that you can diversify in as well. And outside of that, if you're a little more risk averse but you like equity, there's even options called fixed index annuities that can really give you the advantage of the gains in the market but kind of protect your downside risk. And don't let the word annuity scare you. It's a great place to look for a little security but still get some great gains.
So a 60-40 allocation is essentially just a pie chart, not an investment strategy. How do you develop an allocation model today?
Sure, each client, their needs are specific, and so we need to first sit down and do some planning and see what makes sense for them. A lot of people come to us with this idea of a 60-40 portfolio. They've either currently invested in that, they've heard friends, or they hear interviews like this where people mention that. It's kind of the old, what I would call middle of the road strategy, right? You've got 60% in equities, 40% in bonds. The idea there is to give you equity exposure, but still give you the cushion of bonds. Well, over the last 30 years, we've seen interest rates slowly go down. We had the Great Recession, we hit zero, and we're pretty much in that same kind of market now where interest rates are super low. Well, when rates go up, bonds actually lose the value depending on their duration. And so a lot of people are kind of surprised to know that they can actually lose money in a bond fund. And so when we're looking at 60-40, that 40% now is still a cushion, but it can actually be a drag on your portfolio because we're looking at maybe even breaking even, very low gains, or maybe even losing depending on when you would pull money out of that allocation of bonds. And so the other option is, well, we can always do more equity, but a lot of the clients that are in the 60-40 portfolios, that kind of scares them, right? It's unnerving to be like, oh, let's do more equity. And so one of the things we may mention for part of that money, maybe take 20% or half of the 40% and look at things like a fixed indexed annuity where you get the equity exposure, but you minimize your downside risk. And that can really help, again, diversify us, but also make up for some of the lack of returns in the bond portfolio.
Now, it's been said that conventional static allocation models tend to confuse risk with volatility. Do you agree with that?
A little bit. Risk and volatility, they do go hand in hand, but they're not typically the same thing. I think a lot of people get that confused. Risk, are you aggressive? Are you conservative? And volatility is really just, how things are jumping around from any given point. So typically a riskier investment is going to be more volatile than a conservative investment is usually less volatile. That being said, bonds are seen as very conservative, but if interest rates spike, you're going to see your bond portfolio crater. I mean, it can move 10% as well in the wrong direction, just depending on what happens. And so I think it's always important to know what your risk tolerance is. And when things happen with a spike in volatility, sometimes it's a great time to look at your portfolio, because if you've kind of stepped out of your comfort zone or maybe gone out of risk, it's going to show up there first and you're going to notice it. And so it's always a great time to maybe take a step back, get with your advisor, and make sure that you're still in line with all your risk tolerance.
My guest has been Kris Koenig with Prime Capital Investment Advisors. Thanks for watching.